This is Dan Larson. Today I want to talk to you about why it's dangerous to act on proposed tax law changes. The most recent tax reform topic has been President Biden's Build Back Better plan, and this gives us a good example of what often happens with proposed tax legislation. So several months ago, we heard the first version of the plan put out by the President's administration had massive changes that impacted income taxes, estate taxes, retirement plan accounts, affected a lot of taxpayers, and everyone was understandably shaken by it. Several months after that, it made its way through Congress, and a second version passed that was very much stripped down from what the original plan was. Much smaller tax law changes impacted much smaller number of taxpayers, and even that plan didn't make it all the way through Congress. So we're left still wondering whether any version of the Build Back Better plan will be implemented at all. Some taxpayers made drastic changes to their investments, to their estate plan, for fear of legislative changes that have never occurred and may never occur. So how should we think about proposed tax legislation? Should we ignore it completely? Should we follow it closely, ready to act as soon as legislation is passed? Let me give you 3 quick thoughts on how to think about proposed tax legislation. First, we should plan based on current and known tax legislation. So for example, folks have speculated for years that Roth IRAs may be going away. The tax favorable treatment of those will be taken away by the government. But if you failed to contribute to your Roth IRA because of that speculation, you've missed out on all that potential tax-free growth every year that you didn't make that contribution. So second, let's also remember that tax legislation is rarely permanent. We talk about these tax law changes as if once it happens, we never have that opportunity again. But the reality is the last 3 presidential administrations have all passed pretty significant tax reform. First of which were significant tax cuts, then significant tax increases, and then further tax cuts again. So third and finally, let's not ignore proposed tax legislation, but just keep one eye on it as we look to the future. So one of the topics of conversation has been the increase in capital gains rates. If there is going to be an increase in capital gains rates, it doesn't mean that right now we should blow out of everything that has appreciation in it and recognize all those gains now. But instead, maybe we need to think about over time, what do we want to do to sell, donate, and gift our appreciated stock. Thanks for watching today. If you have any questions, feel free to reach out to us. We'd be happy to help.